Hi, everybody. My name is Scott Callan from Ichigo. I'm the chairman here. Thank you so much for joining us today. I'm working off with a presentation that's in front of all of us, FY23-2, first half corporate presentation. I'm joined by Ted Fujita, who is our lead independent director, and also by Dan Morisaku, who is a senior member of our finance organization and the head of our global IR. Thank you, everyone, for joining. We're really grateful for your time. So let's jump through it. I'll go to the first page, which is page 8, and it's kind of the key items of the quarter. Look, it was a good quarter. We don't run the firm on a quarter-by-quarter basis. You know, everything you do over the long term is built off of the success you have in the short, medium term. But it was, you know, it went well. First quarter was light. We had fully expected to get all of it back in this quarter, and that's exactly what happened. Look, it's an incredibly difficult time in the world right now. You know, as there's enormous geopolitical risk, of course, primarily focused at this point in Europe. Global interest rates have gone up very dramatically, with inflation has been experienced for decades. The yen has appreciated very substantially due to the interest rate gaps that have emerged between the yen, which Japan continues to have kind of a very low inflation environment. BOJ does not face the inflation risks that other central banks are experiencing, and to give you some sense of that, I mean, top line inflation here is running at 3%, in other countries running at 8, 10, 13. Core inflation, the Japanese call it core, but it's really core inflation the way it's described in the rest of the world, which is inflation X, treasuries and energy prices. The most recent print had a 1% handle on it. So the BOJ continued to focus on maintaining growth and frankly hitting its long desired 2% inflation target, which is still below despite everything that's happening in the world. So despite all that, we're fine. I mean, this is a business that is rooted in the economics of Japanese real estate and sustainable energy. None of those, you know, the major, it's a domestic business. The macro environment changes in terms of geopolitical risk are not hitting us here in Japan. The global rate increases are not hitting us here. Yen, and where the yen is not particularly relevant to where we run our business. So things are going actually very well. The second point is, you know, Japan reopened literally this week. So on the 11th, we threw open the doors finally to the world. So you can come to Japan. You should. It's fabulous. Continues to be fabulous. It's the same clean, friendly, delicious country that it was 2 years ago before we went into our COVID hiding period. And the yen is literally 30% cheaper, and we have not experienced any inflation really to speak of. So it's extraordinarily affordable. It's a wonderful place, and you know, you might consider coming. So the reopening, of course, is very important to us. For part of our business, we have about a quarter of our assets in hotels. Pre-COVID, that was a great business. In COVID, it was a terrible business. We are reemerging from that. It's mostly RevPAR, so that's revenue per available room. There's a definition of it on the bottom of the page. It's up 85% year on year, so it is really a V-shaped recovery. Having said that, we should be aware that we're still down very substantially from pre-COVID. We're still down nearly 37%. So kind of really what happened is COVID, we're running at 100. At the bottom, we go down to literally 10 to 20. We bounced up to around 60. And so it's a way of saying that there's a lot more to come. In terms of the recovery, not only Japan reopened to the world on Tuesday of this week, it also began its go-to travel program. So all of us living here, to the extent that we have 3 vaccinations, it's actually a condition of being in the program, and Japan is highly vaccinated. So it does mean that almost the entire country is going to be able to take advantage of this program. You get kind of like, you know, $40, $50 a night subsidies to go use hotels. So Japan is open to the world. Japan is also open and has direct subsidies to tourism, which is, quite frankly, about helping all the people who are in the businesses that have suffered, you know, devastation during the COVID period. But it's also in a sense of what you're saying, thank you to Japanese people, you can actually go out and enjoy yourself after 2 years of having robust kind of social distancing to try to protect the nation and everybody in the communities. So anyway, hotels are recovering, and that's fantastic for us. We have a robust cash generation, and it's funding both growth investments and share buybacks. We expect to buy about 45 billion yen of assets this year. I used to use 100 yen to the dollar because it was convenient because the yen was banging around at 100 yen. That's no longer, it's no longer, call it $450 million. Actually, where the yen is right now, call it more like $300 million. That's up 50% year on year. We did 30 billion of acquisitions last year. We expect to do 45 this year. Share buybacks, we did 1.5 billion last year. We've announced 4.5 billion for this year. So that's a 3x year on year. This reflects a very robust recovery in our businesses, and the stock price is banging around 300 yen. We think it's enormous good value. So we have the ability to finance growth and ongoing buybacks, what we think is good value in terms of the stock. Turning to page 9, it shows what's happening across kind of our earnings versus costs, our stock earnings. So these are effectively fixed, kind of baked in earnings, run at about 200% over fixed expenses. On the right-hand side, you can see what's happening in the 3 different business segments: sustainable real estate, SRE, asset management, clean energy. The sustainable real estate business is really important. It's actually off year on year. That's mostly because of vacancies in Odaiba, our big office asset, which we're actually re-tenanting, and so that we expect that to rebound. It's over a multi-year period, it's taken a very big hit in terms of the earnings off of hotels, so we expect to see that the rebounding. It's down 8% year on year. We thought it was going to be worse. We're actually outperforming the plan, and we see kind of a robust recovery in front of us. Asset management is off. That's kind of one-off stuff. We expect to see growth in this going forward. And clean energies is kind of bang on solid because it's just really about our ability to produce clean energy and to bring in new plants online. Turning to the next page, we have started all-in disclosure. I'm not going to go into details on this. It's a way to try to give you more transparency on the value creation that we have in our sustainable real estate business. Next page, page 11. All in OP, so operating profit is up about 50% year on year. Cash EPS is up 24%. Our accounting earnings vary substantially. Under report, total economic earnings or cash earnings are a much better proxy for that. And as you can see, our cash EPS is year to date in the first half is 1.7 times our accounting EPS. It's a way of saying if you take the bottom of the range for our forecast for this year and the data services do, so if you go to a Bloomberg or a Yahoo or whatever in Japan, but by the way, Yahoo in Japan is absolutely huge, more like kind of Yahoo in the United States in 2003. But anyway, if you go to Bloomberg, you go to Yahoo, you go to Quick, you go to these various data services, they'll show us using the EPS number on the page at 14, the bottom of the range, and it puts us at 22 times earnings. If you actually use cash EPS, which is actually a better indicator of the firm, and I'm not trying to position us, it'd be nice to kind of look at the EPS number, which is doubled year on year, and go, wow, we've doubled, we have. Cash EPS is a much better proxy. Look at kind of plus 24%. It's where we are in terms of total return to the shareholders. But if you use the cash EPS numbers and choose the middle of the kind of somewhere in the middle of the range and you do the math of 30, we're actually at 10x earnings, and it's why we think the shares are very undervalued relative to what we see and what we see in terms of forward activity, and particularly with the reopening that is very positive for our business. Next page shows a breakdown within the various segments. Staying on all-in operating profit, asset management is down 12% year on year. That's one-off, links to a one-off increase because of some office asset sales. I'll talk later about the office REIT buying assets, so that will come back. The hotel REIT is much smaller, but it kind of gives you some sense, and you can see on the right-hand side of the page, It's the asset management revenues on the hotel REIT are up 40% year on year, and that's kind of gives you some sense of what the rebound is looking like. Sustainable real estate is doubled year on year. That's primarily led by what's happening in the multi-asset part of the business. Ichigo Owners is going to book a lot of money, revenues and earnings in Q3, so we'll report that. Those transactions that are actually closed, we'll report that in Q3. And in clean energy, it's kind of bouncing around kind of as it is. A little bit of weather effect at -1%, but there's nothing happening there other than it's kind of just running forward. Turning towards the business model and our sustainability focus, page 14 shows what we look like. As you can see on the box that's to the immediate left of the forecast, you can see the first half. If you double the stock earnings, which is in the navy blue, that comes to about 15 billion. We don't expect to get to 15 billion because actually the second half we have fewer earnings coming off of our clean energy business because we go into winter and you just have kind of less production in that business. It's significant enough and is a big driver of stock earnings for us. But anyway, we're well above what we're seeing in terms of the forecast on stock earnings. And we'll have a very productive Q3, and we expect to have a productive Q4 also, and we'll drive our full earnings up pretty substantially towards through the year. Page 15 shows progress and what's happening with stock earnings. I'll go pretty quickly through this. This is material we provide on an ongoing basis, so you can track us. But it is a fundamental element of the firm that we have. As I pointed out in the previous page, both stock and flow earnings, and we have a breakdown and some diversification across our stock earnings, as you can see on this page. Page 16, one of the things that's important about our business is we effectively have embedded forward earnings. We have an earnings bank that for future periods, because what happens is we have, and this is overwhelmingly in our sustainable real estate business, we add value to our assets. And that value is real. And the third-party appraisers will look at our assets and they will assign unrealized gains. But from an accounting perspective, you don't show any value creation until you do an asset sale. So it's to be Ichigo is to be building all these earnings into the future. Page 17 shows actually that those estimates by the third-party appraisers of what are embedded unrealized gains are way too small. Year to date, we've done 1.7x, so we've transacted at 70% higher profitability than the appraisal value, the third-party appraisers would suggest we would have. Generally, as you can see on the page, we're doing about 2x or more based on what our pipeline has right now. We think we'll get to 2x also this year. So this 1.7x will go up. At the current moment, based on transactions that are expected to occur, will go to 2.1x. Next page shows cash generation. We're not about accounting earnings. We're about delivering maximum cash out of the business on behalf of shareholders. In general, as you can see, we also generate economic operating cash flow about twice our net income. Page 19 goes to the point I made earlier. There's that extraordinary instability and I think the right word would be chaos in global kind of interest rate markets, and it's completely irrelevant to us. We were funding at 89 basis points last year. We're funding at 89 basis points now. Continue to borrow as much as we need, and so we're borrowing at 89 basis points for 10-year loans. It continues to be, an extraordinary, wonderful place to be a borrower in Japan. We're taking advantage of that on behalf of all of you, our shareholders. I would point out that there is one probably new driver of demand for Japanese real estate that comes based on this difference. So, for years, Japan was the one place in the world where you could borrow at 100 basis points and buy assets, at 500 basis points. And so you would just get a 400 basis point carry and not doing anything. I mean, this as long as your asset didn't erode in value and didn't have this absolute plunge in your NOI, you would win. And so Japan was an extraordinary, powerful value market. And during the period that went through of kind of global kind of zero-ish interest rates, Japan lost its uniqueness because it's like, well, I mean, it's not quite the same as Japan, but you know, you could borrow the asset for 300 basis points and fund assets that had cap rates of 300 or 400 basis points, and so you could get a positive here in the United States. In the last 6 months, that has completely disappeared. So you were funding at 300 basis points for a 300 basis cap rate asset. Suddenly, you're now funding at 700. And you're deeply underwater. And the cap rate may have gone up a little bit, but not enough. So what's happened is globally, Japan has once again become a unique source of safety and stability in the returns available for real estate assets. So Japan has reopened. We expect, and we're seeing this, that there is going to be a fairly substantial increase in demand for Japanese assets. There's one element that is distinct to what I described you that is also driving asset demand, real estate asset demand from global investors, and that's people taking a view on the yen. Who are like, the yen's at 145, we think that's really good value, and they're buying Japanese real estate for that reason. But that's a completely separate phenomenon. The one that I just described is kind of structural and everywhere. Real estate has just gotten really, really hard all over the world, except for Japan. I mean, it just continues to be an extraordinary place to be a real estate investor. Page 20 shows ongoing progress on our part in kind of being who we are. We care about the world, and every choice we make about trying to move the world forward. And so we are increasingly recognized as being best in class in terms of our ESG principles and our ESG activities, and that and it's a good thing. Financial institutions increasingly care about that, and it gives us access to capital at preferred terms. Next page, 21, speaks directly to one of the essential elements of our sustainability focus. We are robustly climate positive. We have, through our sustainable energy business, which is solar energy and wind energy, we generate 2.5 times the CO2 reduction in terms of our emissions. As you can see on the right-hand side of the bar graph you have in front of you, the light blue is our CO2 emissions. We expect those to go down fairly substantially as we increase the current birds. Kind of our office and our real estate activity to renewable energy sources. Page 22 shows our progress on that. At this point, 60% across the group has been converted to renewable energy. Give you a breakdown on that. I'm going to say it's 21%. I think is the number. Either 21 or 23% is the cutover for ICH. I mean, this company, Ichigo, which we call internally ICH. 100% of Ichigo has cut over, and 33% of Ichigo Hotel has cut over. So this is something that is it's going to happen, and it's going to accelerate over the next few years. And this is important. I mean, global climate change is real. The impacts on people all over the world are real. Actions being taken by us and everybody across the world, including I'm sure you on the call, are really going to make a difference for the future. Turning to more into details on what's happened in terms of core business, page 24 shows our buy and sell activity. I kind of already touched on that. Things are strong. We are increasing acquisitions to reflect our ability to sell with strength at very high prices. You can see the gross profit margin for the first half was 29% versus sale price. Perhaps more relevant, telling you kind of what the uplift is on about activity. Its GPM is 41% against book value. Next page shows Ichigo owners activity over a multi-year period. That is a business which, as you know, or for those of you who have followed this for a long time, and many of you have, and we're grateful to you for that, is a super kind of prime, brand new residential real estate focused in Tokyo, great locations. There's a little bit of stuff outside of Tokyo, but also in super prime locations. Because Japan has done such a good job of defending wage incomes and incomes across the board during COVID, residential real estate continues to be a little bit like a bond here. And it's a bond that actually offers a return other than kind of 20 basis points on the 10-year JDB. So there is extraordinary demand for residential real estate, and that's what Ichigo specializes in. And it continues to be a business that we target at least a 10% gross margin on a hold period. It's generally something that looks like 7 to 8 months. When you include the ability to borrow, have 80% LTV against this, you run the ROE numbers, even at a 10% margin, and we're talking kind of like something that looks like 50%. In actuality, we're generating margins that look like the mid-teens GPM. So it's a business that both is an extraordinarily positive business for us. One, two, those gross margins are actually lower than much of what our competitors. We're providing better value to investors. And three, that probably explains why there's just an extraordinary amount of demand for the assets that we're generating in this business. Next page shows some of the business model implications of what we're doing for owners. One way of thinking about it is your ability to buy well is directly linked to the ability to sell well. We thought of this business originally as primarily going to be, we're going to serve kind of cash-rich individuals and corporations. It turned out that actually there was this huge demand from institutional investors to have kind of, take kind of 15 residential assets, each of them $10 million, and buy $150 million portfolio was something very attractive to institutions. So that became the bulk of our activity. We continue to do some direct sales activity to cash-rich corporations and individuals. And the ability to broaden out and have a diversified and stronger kind of set of channels for selling out of this business is important to us. So we started a new co-ownership business, meaning by co-ownership, we mean kind of small lot. You can own kind of at $10,000 a shot, kind of real estate. It gives you direct ownership. Unlike a REIT, you can get the tax advantages from that, from the ownership. The same thing that we do with the way we run our business in order to have the tax shield from depreciation activity. So building out the sales channel for that is important to us. We announced recently a brokerage relationship with our Amazon networks to do that. But it's a way of saying we're continuing to build out not only our kind of core capability in acquiring real estate. We buy super prime residential empty, and we lease it ourselves, and we do it really quickly. And we can do it really quickly because we buy assets in good areas, and this is a business we know really, really well and can underwrite really well. And then the ability to sell this in all sorts of channels is important and interesting to us. So you'll see more developments in terms of our channels as we go forward. But this is something that's a real growth driver for us. Turning to page 27, just to give you some sense of something we're doing that is it's primarily got an ESG focus, but it also has direct implications for us growing kind of our brand and also a potential new source of income for us. We've started, we've actually taken control of a public-private partnership in Yokosuka, which is right next to Tokyo. We've taken an old port owned by the city of Yokosuka that they were going to tear down and turn into, I don't know, apartments or something like that. Our suggestion was, and this is what we do, our sustainable real estate business, we are violent against the idea that you should just be tearing down old buildings. It is profoundly bad for the world. It's wasteful of resources, it's wasteful of money. At the core of our business is we take existing assets and reposition them and we make something into something. So that was the idea. It was an old warehouse that was going to be torn down. No, let's not do that. Let's keep it. Let's keep kind of its essentialness, its integrity as that kind of an asset and turn it into something new. So we are repositioning it. When I said it was a warehouse, I mean, they had a ton of kind of wholesale kind of retail going on in there and turning it into something that's actually brand new and really interesting. We're targeting 1 million visitors per year. It opens this month. And the next page shows kind of what the positioning on it. It is focused on local food and agriculture. The Miura Peninsula runs up into kind of Yokohama and it's next to Tokyo. We think it's really exciting, really interesting. It helps kind of develop another kind of business model for us. So we have been we're asset owners, we're asset managers. The business model in this case is effectively a content kind of provider, a coordinator, a master lease operator for a public entity because the land and the asset continues to be owned by the city of Yokosuka. I think it's really interesting. Page 29 shows our 3 public vehicles: Ichigo Office REIT, Ichigo Hotel REIT, and our Green Infrastructure Fund, which are, have, particularly the hotel REIT has suffered during the COVID period, as you can imagine. Even having said that, it's running a dividend yield of over 2% in a country where kind of the bonds effectively pay nothing. So it tells you how robust the performance of that REIT has been, despite kind of everything that's gone wrong in the downturn. Next page describes kind of activity we're doing to support acquisitions by both the office and the hotel REIT. We do think there's going to be growth in both of these REITs, and that growth will be positive for the REIT shareholders, and we expect to be positive. Ultimately, the sponsor of these REITs, we do earn asset management income off of the REITs, so the growth will be positive for all of us as shareholders of this entity also. Page 31 shows activity in the clean energy business, which is slowing down in our classic kind of feed and tariff part of the business. As you can see, we expect to have we're bringing 3 new plants online this year. 2 of them are already online. So it's really kind of what's more interesting. And we have a little bit of a pipeline, which you can see in the royal blue on the upper right hand side. But this is our kind of the feed and tariff business in solar and wind. We have kind of a couple of things that are going on because we fully intend to grow this. I mean, look, both what's gone so horribly wrong in the world with the Russian invasion of Ukraine, is obviously it's a humanitarian disaster and a crime, and it is also something that has impacted everybody globally through the kind of transmission mechanism of kind of enormous increases in energy costs and strategic insecurity linked to those, to the region energy. So doing everything we can to move off of fossil fuels, to move off of imported fuels, and to move off of reliance upon dictatorial regimes is clearly very important for the world, and that includes Japan. So everything we're doing here is important. We have 2 kind of major initiatives. One we've talked about before. We have a green biomass initiative, and it's local and it's green, which is, we can go through this in the Q&A if we want to. There are elements of biomass that are emphatically not green. We will not do that. So anyways, this is genuinely green and local biomass that we expect to. We have kind of 5 or 6 plants in the pipeline. It probably in the next kind of year we'll begin activity in this area. Total investment will be something about 50% relative to the existing kind of set of assets we have. So in other words, about 50% growth is what we see as kind of an immediate kind of short-term runway on that, and we would expect to do more over time. And then the other, but that's not on the page right now. But that we see that as a growth opportunity, and actually bigger than that is moving into non-FIT, so non-feed and tariff solar. Our current target is, as you can see on the page, we have 143 megawatts of current operating plants. Our target is to do about, and it's all under the FIT regime. Current target is to do about 100 megawatt. It's our short-term, midterm target, as you call it. Anyway, we'd like to do a lot more than that, but anyway, for the moment, we're going to go for 100. It seems like a round number and big enough to be interesting. And with respect to about 40 megawatts is visible at this point as a pipeline that we expect to deliver, meaning kind of the conversations are well underway with providers of land for us to operate on that land and provide. And this will be solar. And the next big element of it is solar power has become enormously competitive globally, and that includes Japan. So we don't need to rely upon a government program to have highly competitive solar power prices, and it doesn't require us to have the current kind of high levels of fossil fuel prices for us to continue to be competitive. So this is a business, so the phrase that's used is grid parity, where renewable energy becomes able to stand on its own feet without any help from government. We have reached that point, and that's a good thing. So we expect to build a fairly large solar business that will have many of the characteristics of a fit business, meaning that we expect in many cases in long-term contracts with purchasers who want to own solar and want the security of solar. One of the things that is increasingly the case is there a recognition of the extraordinary volatility in energy prices that's linked to geopolitical risk. And so the ability to know that the sun is not going to change based on what's happening in Europe or Taiwan for that matter is actually really important to a lot of purchasers. Next page shows activity in terms of share buybacks. This is the 6th year in a row that we bought back stock, and as I said earlier, this year we're executing 3x of what we did last year. And finally, page 33 is a reminder that we have a J-League shareholder program, which is pretty innovative in the way we're trying to take advantage of. So we're sponsored with the J-League. We've actually have put in place two consulting contracts with J-League teams. We think there's going to be an opportunity to do things that are interesting in this space in terms of content, the effective use of real estate, but and the branding kind of value is very significant. If you watch the J-League games on TV on a very regular basis, you see this huge Ichigo kind of banner show up, which is great. But there's branding value. There is ongoing commercial value to the business. And the other thing is, generally what happens with sponsors is you get all these tickets because you're a sponsor and kind of people give tickets away to, I don't know, their employees or I don't know, the CEO, takes his or her relatives. But in our case, we think these tickets belong to our shareholders. So we have a program where we're giving away our tickets to shareholders, not only of this company, but of our REITs and our listed solar power producers. Thank you for your patient listening. I know I spoke quickly. There's a lot to talk about. I kind of stumbled on words. My apologies for that. I'll try to speak English better. And now ready for a question and answer or any comments or any and all feedback. We're grateful to have you on the call with us. Let's see. Greg, you have raised your hand. Are you able to talk?
Yes. Can you hear me, Scott?
Yeah. Thank you, Greg.
Yes. Hi. Thank you very much for the presentation. My question would be on the follow-up on the hotel business. So as you mentioned, Scott, about 25% of the portfolio is in hotels. My understanding was that you were looking for the, for the situation to improve to perhaps sell some of those hotels. I've seen that at the same time you actually bought 2 hotels. Can you maybe develop a little bit on that, on the portfolio rebalance? What's the plan and any particular kind of fine-tuning on that? Thank you.
Yeah. So one of the things that we are increasingly doing is we're looking hard at how we grow our asset management business. So one, without putting too fine a point, but it's not necessarily the case that when we take and very explicitly in the case of offices and hotels under our balance sheet that we expect to list data. So that is kind of and look, we think the asset management business is an important business. I mean, Japan can't fund the future without higher returns, and so there is significant social value for being an asset manager who is truly a fiduciary in terms of the operations and the success that deliver to shareholders. We think we have a very strong track record. We are the only, actually both Ichigo Office REIT and Ichigo Hotel REIT are the only 2 REITs in Japan that have only performance-based fee income. We think it creates strong alignment. And so, again, Japan has not escaped from its 0 interest rate period, and so this huge demand for a return that we think, going back to the point I made earlier, that we can offer manifestly in offices, and we think in hotels. I mean, hotel, we just had to go into hibernation because of COVID. It was not prudent to doing much there. So what's happening with our hotel portfolio is we are kind of, how should I describe this? I mean, non-core assets are going to go out the door. Things that are of interest to us potentially in terms of value add in a sustainable real estate business and exit into a REIT or a third party investor are interesting to us. But it is ongoing kind of view. The problem with hotels, the advantage of hotels is the cap rates have pushed down really, really hard. And so increasingly, if you want to buy a good asset, that's an office asset or a residential asset, the cap rate is looks something like a 3. It could even go down into the 2s. Hotels provide some opportunity, and they're harder to manage, meaning they're operating assets. There's some ability for us to add value, and you can get a cap rate kind of that looks normalized. That can be a 5 or 6 or a 7. So recognizing that COVID has not completely come to an end, and when I say that specifically, I mean because 20 to 30% of tourists inbound have been coming from China, and they're not coming at this point. So really to get full normalization of the Japanese tourism market, we need to see a reopening of China also. But we think there are interesting opportunities there. But there's, we capped ourselves at 25% of our portfolio in hotels for a reason, because hotels reprice daily. That fundamental kind of risk outlook on hotels, despite our ability to make very good money there, has not changed. So what you're seeing is a little bit of portfolio repositioning. We think we're strengthening the portfolio. We're going to generate. We're going to do 2 hotel sales this year. They will both be profitable, and we'll fully expect to do profitable hotel sales in the future, and it could well also include into our hotel REIT. Greg, did I answer your question?
Yes, thank you. And then a separate point, if I could ask an update on the Tradepia building in Odawa. How's that going for the vacancy?
I try to be super direct, if that's okay, and so hopefully you're not going to go screaming from the room. So, Odaiba's not going particularly well, which is to say, vacancy at this point is about 55%. I'm sorry, occupancy about 55%. So Odaiba was this, it's a single big asset. It's the only large office we own. Our experience with it has given us kind of every reason to understand why it is that we all, for the most part, do not participate in large office assets. And we bought it at a very good price, and it continues to, be valuable, and this is going to be a way forward. But the office experience that we've had in a large office has been terrible. Just massive vacancy, big exits. It had a very high kind of IT elements in its tenant composition. When we went into COVID, we thought that was great because IT companies are very profitable and they're growing. And then COVID happens, and the IT companies are like, actually, we don't need to be in the space, and we're giving it back to you. So that and kind of all this kind of, it's interesting, but small and medium companies have largely held their real estate, office real estate, in parts because they're competing for talent. There's a shortage of talent. Being able to provide more space for employees has been important to them. Unlike the big companies, which I guess have a brand and they don't have to compete for talent the same way. I've been giving them back much space. So anyway, so Odaiba goes from being this fantastic performing asset, similar to our hotel portfolio, to being a terribly performing asset due to COVID, and then leasing it back up. We thought we were going to get to 80% occupancy this year. I think at this point it's probably unrealistic. Looks more like 70. And our small and medium kind of portfolio, which is every other asset that we own in an office, is running at kind of like 95% occupancy. It's just completely night and day. So that's being tough. I mentioned on a Q1 call that we're taking a very hard look at how we're repositioning things we can do with it, and we actually had a board meeting today. We talked about it because I think we need to do something new and different, and new and different is good for the world, and I think we can do something new and different that's good for our shareholders also. But Odaiba is the one kind of weak point in everything we're doing. Everything else is kind of firing in all cylinders, and Odaiba is not right now.
Okay, great. Thank you very much, Scott.
Thank you. We're happy to take any questions. I did get a question in advance, so someone who couldn't be on the call, so let me address that. And the question was, Taka the Carl Laban Infrastructure Fund. There was a TOB, so that is a peer. It's a solar power listed fund. There's a peer to Ichigo Green. There was a TOB for it by its sponsor on September 28th. The TOB runs to at about a 10% premium to the existing share price. At the time, the TOB runs to November 11th, I think it is. And the question was, what do you think of the TOB? You know, what do you think of the price? And what do you think of the kind of what's in the kind of the effectively the TOB offering memorandum, where the sponsor says we really need to do this because we're at risk of going kind of negative return in it in this business, meaning that costs are going to be higher than our earnings. And there was also a commentary about how kind of restrictions on solar power purchasing within the FIT regime, so the feed-in tariff regime, could be very negative for the infrastructure fund, and therefore we think it makes sense for us to take this private. So look, we're in the midst of a TOB, so I prefer not to make comments on, you know, this is a fantastic TOB, this is a terrible TOB. I mean, the share prices are trading, it's trading kind of right around, a little bit under the TOB price, which suggests that there's arbitrage activity going on. At this point, no one has shown up and said this is a terrible price, I'm going to pay more for it. So I hope the questioner will allow me to kind of leave that one as it is. I mean, it seems to be trading fairly normally. But with respect to these kind of the classic kind of, you know, memorandum things, partly drafted by lawyers, I suppose, and partly to convince shareholders that they could sell it. You know, we've got all these issues with respect to kind of us going negative earnings and restrictions on power output. We quite honestly don't see that. And then we'll go directly on that topic. We don't see it. We have a very large, we have our own Ichigo Green Infrastructure Fund. We have a very large solar power business. Don't see it at all. So it's interesting that it's said right down. I mean, and actually very specifically, this whole thing about power restrictions. So if you produce too much solar power and the grid can't take it, then the government has a right to say, you know, we can't take the power, and so you have to turn off your solar power plant. And literally, the number of instances of that has halved in the last couple of years, because the EPCOs, the electric power companies, have introduced kind of more flexible and smarter grid mechanisms. So it used to be, and they couldn't accommodate kind of, you literally turn off power for an hour or 2 hours, you had to turn it off for a day. And so the number of restricted power actions has plunged. I just talked earlier about kind of this very robust demand for renewable power. The grid is getting smarter in Japan, so we actually would not share the view that was implicit and explicit in the TOB materials saying, you know, we think there's a problem and we need to take this private. Now, there's one thing that is one other element on these listed infrastructure funds, which is why I don't call them REITs, because they're actually not REITs. So REITs have kind of permanent tax-free status, and kind of you pass through the income without having to pay corporate tax. The infrastructure funds were set up in Japan with only 20-year tax-free, and I don't know, we're probably like 10 years into this at this point. So that tax-free window is getting shorter year after year. That's undoubtedly an element of kind of the infrastructure fund as a vehicle, completely separate from whether solar or wind makes sense in Japan, because they do make sense in Japan. That's a completely separate kind of issue that I'm sure the sponsor was thinking through when they decided they want to take this private. Anyway, that was a question that came in advance. So I'm happy to, now that I've answered that, happy to go to all of you on the phone, on the web, as it were, any and all questions. I'm going to leave it there, unless there's anything for anybody else. So before I, you know, you're all busy. It's a difficult time in the world. Unless there's anything from anybody else, we'll bring this to a close. Again, thank you very much, all of you, for your time. We're grateful to spend time with you. You know, quite honestly, it's actually reasonably difficult to ask questions on a forum like this. It's not, and it's very common for us to take questions for you offline, and we welcome that. So thank you very much for your time today, this evening, this morning, wherever you're in the world. And it's an honor and privilege to work for all of you. Take care.